Well, there's a lot written on the science of this subject in finance textbooks. So I think it's good to be familiar with that stuff. I don't put a lot of credence in it. Things like capital asset pricing models and beta portfolios and diversifying away your non-systematic risk. A lot of that stuff is interesting theories, and any investor should be aware of those theories because I think it gives you an interesting way to think about the world. But I think a lot of it really comes down to doing the hard work, thinking about your individual positions, the things that can come along and affect them adversely, to think about the macro problems in the economy, the risks that could come. A lot of the terrible risks typically surprise people. They're not things that everyone's worried about or talking about. Like Y2K was talked about greatly before the change of the millennium, and it ended up being a non-event. It's whatever people are most fearful of at the moment in the market is probably not the thing that's going to strike you. It's probably something else. So knowing your positions, knowing your companies, knowing why you own them, knowing what external forces are important to that company, thinking about scenarios, and ensuring that you have a margin of safety in your investments, I think is the most important thing, rather than sort of running around and basing every decision upon sort of headlines and macro risk news that flies around, but really understanding in a deep way your positions. That gives you a framework for assessing the outcomes.